All right, now let's proceed. This is hybrid accounts. And right now, we're just going to take a look at how to consolidate the statement of financial position. You could be required to consolidate a statement of financial position, which is also available for F7. Consolidate statement of profit loss and other comprehensive income, also available in F7. But also here in FBR, you can be required to consolidate the statement of cash flows. So you have to note about that, right? Of course, even in some situations, in FBR here, for the previous syllabus, for the previous syllabi, actually, we are always required to prepare the consolidated financial statements actually. But now, right now, some things have changed, so the question might come in a different way. So you really need to understand what consolidation means. But for the sake of learning, we would have to prepare the statements, right? So as to understand what is going on. All right. Now, here I've just written a statement of financial position, but along the way, for some adjustment, we also need to learn the statement of profit or loss. Okay. The general guidelines are as follows. First of all, now we are just going to consolidation. Listen very carefully. When you say that you are consolidating something, it really means that you are just going to buy equity. This is what you need to understand here. I hope you know what equity is. Equity is equals to assets minus liabilities, right? Yeah. So whenever you take a look at consolidation and you say that you are just seeing a subsidiary, it's like you are just going to buy the equity of a subsidiary. Now, to buy the equity of a subsidiary, you do not buy for nothing. You pay. There must be the purchase consideration, or sometimes we call the investment cost. So that's why after in the separate books of the parent, you would have that purchase consideration or investment cost, usually is a non-current asset, but also you would have the equity of a subsidiary under equity. Now, after consolidating them, that investment cost would disappear, and also that equity of the subsidiary would disappear. You have to understand that much. If you view the consolidated financial statement, you won't see that investment cost, the amount that you paid, but also what you bought. It's like you're going to buy an orange, and let's say the price of that orange is the equity of company A, but you are company B. You are company B, and you go, maybe you pay for something. The amount that you pay is the investment cost of company B. Now, when you consolidate them, neither that selling price will appear in the books, but also neither that cost won't also appear in the books. I hope you get what I'm just trying to speak of. Later, we'll see how to determine something called goodwill, but then you would understand what I was just speaking of here. All right, so we have to follow the following. First of all, I'm writing here, eliminate the carrying amount of the parent's investment in its subsidiaries. Simply speaking, it's like, let's say, you have gone to purchase something by paying someone kind of the selling price, right? So eliminate that investment. So you eliminate that asset and then you replace it by another asset. So usually you would eliminate the investment in subsidiary and then you would replace it by goodwill, asset for asset, right? Now you have to proceed down here, but I do not need to explain this one. I need us to go, let's go to the last session. This one will be the second point. Leave this alone first and let's go to the last session. Here, eliminate equity of a subsidiary, which is like the cost of what you are just going to purchase, which is the equity. Eliminate the equity of the subsidiary, and this would be replaced by the non-controlling interest. Did you get the point here now? The equity, non-controlling interest is also equity. We just saw the definition, but non-controlling interest is also equity, but it is not all of the equity of the subsidiary. It is just the equity that is attributable to those people other than us. Let's say we purchased 80%. Now it is just the equity corresponding to the 20% that we as a group do not control, right? I hope you got me here. So let me tell you one thing. If you combine this one, investment in subsidiary and goodwill, but also equity of a subsidiary and non-controlling interest, that's where you find the workings of the goodwill. Usually you have workings for goodwill. That's why you obtain that. Don't worry about this. I'm just going to describe it much deeper, in a much deeper way, right? So I'm just going back here and say here, after that now, when you say you are consolidating something, it's like in the statement of financial position, you have assets and you have liabilities and you have equity. And for equity, I've already explained that. I've said that eliminate the equity of a subsidiary and then replace it by non-controlling interest. That one is over. About how to determine non-controlling interest, don't worry about that now. Now we are left with assets and liabilities. When you have assets and liabilities, whenever you are controlling an asset, we say that you have it. So just add it to the books. Do not say, oh, I'm just owning 80%, so take 80%. No, just add it as it is. So add together the assets and liabilities of the parent and its subsidiaries in full. Again, I'm repeating in full. And then eliminate intragroup transactions and the balances. Now, what do we mean by saying eliminate intragroup transactions and balances? What do we mean by this? Let's say I'm a parent and you are a subsidiary. I sold goods to you. After selling goods to you, you have the goods, right? You have the goods. Let's say the goods are actually, I purchased those goods at $30 million, but I've sold to you at $35 million, meaning that I've earned a profit of $5 million. But let's say at the end of the period, 40% of those goods are still in your books, are still in your store. And remember, we are just going to consolidate the financial statements. So those goods that were appearing to be in your own separate financial statements are also now mine, because you and I are now the same thing. We are now like a single economic entity. So it's like I've decided to sell the goods to myself. It's like I, as an entity, I say, oh, these goods are costing $30 million. Let me sell them to myself. So I'm selling them to my own entity. So it's like I'll be just trying to force to have the profit that is non-existent. And so we say that we need to actually eliminate those transactions and the balances. I hope you got what I was just trying to speak of here. So just add the assets and liabilities, but also eliminate those transactions and balances that were intra-group, that were relating to the parent and subsidiaries, for example. How? Let's just try to take a look at the scenarios. IFRS 10 states that all intra-group balances and transactions and the resulting unrealized profits, we'll see about unrealized profit, should be eliminated in full. Right? Eliminate them in full. But also say unrealized losses, you can have unrealized losses. Of course, this isn't common, but in case you have unrealized losses, you also have to eliminate them unless cost can be recovered. In that case, now you can just stop eliminating them. So the practical example is here. For example, take a look. What should we eliminate? Eliminate trade payable, trade receivables, and trade payable. It's just an example. This is the statement of financial position, but I need you to understand. So I'm going deeper to the income statement. Also eliminate sales and purchases, but this would be for the statement of profit or what? Or loss. How and why do I say this? Let me try to give you a glimpse of something, and so that we can know what I'm just trying to speak of. When you are an entity, let's say you are an entity, you are entity A, and then you are selling goods, to entity what? To entity B, just like this. If you are entity A, let's say you are a parent, doesn't matter, you are a parent, you are a subsidiary, whatever. You sell to entity B. When you sell to entity B, let's say you have sold goods on credit. I need to give you a glimpse of what I was just trying to speak of. Ignore the consolidation in the separate financial statements. If entity A sells goods to entity B, the normal treatment of foundation F3 financial accounting usually say that you have sold goods, but you haven't received the money. So you have to say debit trade what? Trade receivable. This is what we usually say, right? Debit trade receivables. And then you have sold. So we say credit Howard, credit sales revenue, or just sales. This is what we usually do. And for entity B, what do we usually do? For entity B has purchased goods from entity A. So if entity B has purchased the goods, we say that entity B has purchased, so entity B says purchases, right? And then after purchasing, we say that entity B has to pay something here, right? entity B has to pay something here. So we say credit trade payables, right? Trade payables. That means entity B has to pay something to entity A. So, simply speaking, regardless of whether you are preparing the statement of financial position or the income statement, you would have to eliminate this. So, you know, as I told you, you usually add up the assets and liabilities. So when you add up the assets, these receivables would be there. You would have to remove them. You actually reverse. You reverse all these what I've just written. Just reverse them. That's what we say to eliminate. So reverse the entries. Reverse the what? Reverse the entries. So if you have you would have to credit trade receivables, meaning that to remove it, and then you would have to debit trade payable, meaning that to remove it to the statement of financial position. In the income statement, which you are not yet there, you would have to remove sales revenue, so you would have to debit them. So go to total sales revenue, remove them. Purchases, purchases always form the part of cost of sales, so you go to cost of sales and also remove that. I hope you got me. So consolidation, some people say, oh, consolidation is difficult, but that's not true. Someone doesn't remember this basic logic, and then they say you have to remember a lot of things. That's not true. It's totally wrong. All right. So after doing this is what I was speaking of here. Right. There is something else now. We said that you can have unrealized profits, but don't worry, you are just going to take a look at those things called unrealized profits soon. You'll see them. Unrealized profit is, let's say maybe you sold goods to someone for 30 million, but maybe you purchased them for 25 million. That means you earned a profit of 5 million. Now, if you have that 5 million that you have earned, you have earned 5 million, right? If you have earned 5 million, what do we mean by that? You have earned, let's say here we say that sales were actually 30 million, which cost how much? Which actually cost 25 million. This means that the actual profit earned there was 5 million. But you are told that at the year end, let's say 30% of goods are still in store. 30% like this, 30% are in store. If 30% are in store, what does this mean? It means that of the 5 million profit that A presumed to have earned from B, actually 30% are still in B. And remember, B and A are now one thing. So it's like A sold some goods to itself. So you have to eliminate them. And so we usually call something provision for unrealized profit part, something like this. How do we get that? You take that 30% and then you multiply by the total profit that was 5 million, which gives you a total of 1.5 million, just like this. So this is the provision for unrealized profit, which you have to eliminate. Now, how do you eliminate the provision for unrealized profit? It's something that is pretty much easy. To eliminate the provision for unrealized profit, you just consider yourself. You consider who sold. The one who sold would have the profit. A sold, so A had the what? Had the profit. Profit is on A. And what? B purchased. So B purchased. If it was goods, B has inventory. So inventory is in B. So all you need to do is just to eliminate that. Inventory is an asset. It has a debit nature. So to eliminate inventory from B, you just credit. You say credit inventory, just like this. From B, since assets are just added, no need to specify. You actually remove inventory from B, but you remember the asset would have been added together, so no need to specify. And then you have to remove the profit. Profit is of a credit nature, so to remove profit, we say that you have to remove the profit. Now remember, how do you remove the profit? You know, the profit appears in the income statement. So since we are speaking of inventory, and the inventory has a very strong link to the cost of sales, cost of sales equals to opening inventory plus purchase minus closing. So instead of say debiting, what do we debit in the income statement? We go to the line of cost of what? We go to the line of cost of sales, and then we complete this, right? But this was if we are dealing with the income statement. I have to deal with everything here, right? Now, suppose we are dealing with the statement of financial position, as we have just spoken above there. What would you have done? If you debit cost of sales, that means you reduce the profit. Profit usually goes to retained earnings. So this one should go to retained earnings, just like this, right? So in the equity and the statement of financial position, it would go to retained earnings. Now, retained earnings, remember, profit A. Remember one thing, I told you that when dealing with consolidation, consolidation is all about purchasing equity. So whenever you are touching something about equity, you have to know whether this equity corresponds to the parent or corresponds to the subsidiary. Let's presume that A was the parent. Presume this. A was the what? Was the parent. And let's say B was a subsidiary. I'm just writing here. Oh, this one. B was what? A subsidiary. Subsidiary. Just like this. So we would say that, oh, so it's A who earned the profit. A is the parent. If parent A, profit of the parent is not shared, but profit of the subsidiary must be shared, right? So if A was the parent, it's obvious that this one would have gone to the group retained earnings. You know, parent is correspond to the group. So say what debit group retained what? Retained earnings. Now let's reverse this. Suppose A was the subsidiary, A was the subsidiary, and now B was the parent. If if A was a subsidiary and B was a parent, what would you have done here now? A subsidiary and B is the parent. A is the sub, and then A sells to what? A sells to B, and we are told that B is a subsidiary. What would you have done? If B is the parent, sorry, B is the parent. If A is a subsidiary, yes. Yes?
No, I was just trying to correct the typo error.
All right.
B from your analysis should be a parent.
Yes, I've changed. In the case A was a subsidiary and B a parent, this profit now would be belonging to A, which is a subsidiary, and so I would have to debit cost of sales, no issue. But remember, this one would affect the subsidiary, right? And then to the group, since I affected profit of A and A was a subsidiary, I told you that in consolidation, we share the equity of A, and you know, profit goes to equity of a subsidiary. So I will have to share that one. So to do that, this one would go to not to the group retained earnings, it would go to the subsidiaries retained earnings. Now, for the general working that we usually do, no need to know about subsidiary retained earnings because we usually prepare a working for the net assets. You know, retained earnings is part of equity, and equity is called net assets. We usually prepare the working for net assets. So you will find out that you can put provision for unrealized profit in those net assets if subsidiary is the seller. You would see that later and in a very clear manner, right? So just remember to understand about that. Okay. So that's what I just wanted to speak of. But now remember one thing. A parent can sell to a subsidiary, but also a subsidiary can sell to a parent. Now, when you study about investment in an associate, you are just going to learn more about this provision for unrealized profit. Because a group can sell to an associate can sell to a group, or it can purchase from a group. At which point, you would also have to deal with this provision for unrealized profit. The other thing here that I would like to speak of is to clarify is, so far we have spoken of the business between the parent and the subsidiary, but you know, there could be the financing arrangements. Usually a parent can lend some money to a subsidiary so that the subsidiary can prosper, right? So you could create the interest.
Sorry, Fred.
Yes.
Sorry, Fred.
Yes.
I want to ask you a question. You said IFRS 10 states that all intra-group balances and transactions and the resulting unrealized profits should be eliminated in full.
Yes.
Okay, so these very statements suggest that it is only the unrealized that should be eliminated, not the total profit made from the subsidiary.
Yes.
Okay, or from the parents. Either way.
Yeah, either way.
Okay, all right.
And
Go ahead.
do you know the reason? The reason is, if I sell goods to you,
Maybe I should attempt. The reason is because we are
yes,
going to uh, consolidate both the liabilities and the assets. And
yes,
if we are consolidating stock, uh, the stock that we are consolidating is already sold. And so if we go ahead and consolidate, that will result to double counting. And then in terms of profit as well, something that hasn't been realized, and I am already counting it as realized because we are consolidating. So because we are now
one
producing
thing,
a single statement, a
yes.
single account, it makes sense to eliminate all unrealized profits. I think that's my own understanding.
Of course. You have to eliminate the unrealized because right now, when you combine the statements, it would be like you just made a decision. Or you remember, when you sell, you include them in your sales. When you purchase, the other purchases and include them in the cost of sales in
Sure,
case of that
sure.
situation. So in that situation, when you combine those results, it's like you would have the sales, but also you would have those cost of sales in your books
The
because you
cost
have
of
added
sales.
them.
Yeah,
So it would be like you have
yeah.
said, oh, I have the books at 30 million. Let me pretend that I've sold them to myself, and then I increase sales, and then I put something in cost of sales, but I still have the goods.
Mm.
So in case they haven't got out of the group, you would always have to eliminate provision for unrealized profit, right?
Yes,
Right. And
that's my yeah.
another thing here now, it could arise that maybe there is a finance arrangement. Maybe a subsidiary is weak financially, and the parent has decided to lend a hand, and maybe it has the subsidiary maybe has issued some financial liabilities, and the parent has subscribed to that. So there is actually someone is owing, maybe a subsidiary owes some money to the parent in a financial arrangement, not business-wise. So you could create interest receivables and interest payables. But also you could create interest income and interest expense. But also you could create loan liability as well as loan asset. I hope you got that. A parent said that, oh, you as a subsidiary need some money, so it lends some money to the subsidiary, right? Let me do this. These things are very important to make clarifications. I believe after doing this, when we just go through that one, it will be very easy because I need you to go through these small things before proceeding further. So let's say that A is a parent. Oh, no, A that is a parent, maybe sells, oh, gives a loan, finances, finances B, that is a subsidiary, right? For a certain amount of loan. So in the books of A, what are we going to do? In the books of A, I would say, oh, A has given the money to B. So A has given out the money, so A has credited let's say the cash to B by a certain amount, no problem. And then we say, oh, so A is entitled to be paid. And so we say that A has to debit a financial asset. Let me just write in short, let's say a loan asset. Let's just simplify matters. Right. Oh, sorry. We have about 10 minutes. Loan asset, just like this. But at the same time, we have B here. We have B here. And what has B done? B has actually received the money. So B has debited cash, right? And at the same time, B is actually owing that amount. In due time, B should pay back. So we can say that we have the loan liability, right? Just like this. So you have to eliminate these ones. Now, as for cash, you won't find something like this because remember, here you remove you would have some the asset. You remove the asset, the cash, but also you increase the cash by the same amount. So there is nothing, right? Contrary to what we spoke of trade receivables and trade payables, because trade receivables are their own line item and trade payables have their own line item. That's why we eliminate it, right? So there would be no need to deal with cash, but as for loan asset, you would have to remove this loan asset. So you'd have to credit to remove it. And for loan liability, you'd have to remove that from liabilities. That's number one. But also now we proceed and say, when there is a loan, actually it will bear interest. So in case it bears interest, as a company A would have to receive the cash from interest. Let's say the year has ended and it is yet to receive. We say that this one has interest receivable, right? Interest receivable, is an asset. Interest receivable, just like this. And then we have to credit interest income, because income is income whether you have received or not. As long as you have earned it, you have to record it as income. Interest income goes to the statement of profit or loss, right? Statement of profit or loss, just like this. Statement of profit or loss. Statement of profit or loss. Interest receivable is an item in the statement of financial position. And then for B, which actually has to pay the interest, would say that B had the interest expense, which also goes to the statement of profit or loss, and then the same B has to pay something. It's either it has paid, so it's a cash, or it is yet to pay, so it has the interest payable, right? Just like this interest payable. Interest payable appears in the statement of financial position, just like interest receivable appears in the statement of financial position. So actually, I've never encountered something like this, but here you really need to know the real circumstances that you encounter. So most of times you would be told that this interest was actually received, so it is cash, and this interest was actually paid, so it's also cash. If it's cash both ways, that means we're speaking of the same line item and no need for consideration. But in case it wasn't that way, you would have to eliminate interest receivable as well as interest payable. Now, for interest income and interest expense, you would also have to eliminate them. So you just reverse these entries. So you really have to know something like this. All right, in the future, we would also have to check about something called dividends. Actually, let me give you a glimpse. Dividends. Dividend, let's say a parent, maybe someone paid dividends. If the subsidiary, if the subsidiary paid dividends, as for the parent would have received the dividends. So if the parent received the dividends, what should the parent do? Just remove those dividends. Dividend is an income, dividend income in the income statement. So just remove dividends. Remove dividends from what? From the statement of profit or loss by debiting. Remove those dividends. If you remove those dividends, that means you reduce the profit. So that profit should also go to the group retained earnings. Group retained earnings will also remove them. So there are just matters that you need to get a glimpse of, so that when you go through it, it becomes much, much easier, right? Another point that I just wanted to insist here is you will find in those videos there is something called cash in transit as well as goods in transit. As for cash in transit and goods in transit is something easy. I just showed something here. I can just give you a glimpse of what I'm about to, what I need to say. Yeah, maybe consider these things. Yeah, if you just take a look at this one, everything will be over. I'm just trying to speak things from the fundamental point of view, so that when you go through them, you do not just say, oh, so this is usual this way and this one is usual this way. If someone sells goods to another, let's say they have already dispatched the goods, they would have recorded this one, debit trade receivables and the credit sales revenue. But presume that this one is yet to receive the goods. If the goods are yet to be received by company B, we call them goods in transit. So in consolidation, for the sake of consolidation, we presume that B has received these goods. So you have to pass these entries, right? These entries here. If you say purchases, we mean that we have purchased, but we are pretty sure that all of these purchases would be the goods in transit, because they will still be in the group. And as I told you, all the goods that remain in the groups, you have to determine the provision for unrealized profit. So you definitely have to determine the provision for unrealized profit for goods in transit. And after doing that, then we say that we would have made entries on receivables and on payables, and you can proceed to eliminate them as I said before. So that one is goods in transit. But also you could have cash in transit. By cash in transit, it is the reverse. B has to pay. If B has to pay, B has to pay, B has to what? B has to pay. If B has to pay, now you ask yourself, if B pays, that means that they would extinguish the trade payables. So they'd have to debit trade payables like this. They would have to debit trade what? Trade payables just this way. And then B has paid cash, so they have credited cash just this way. But if this one is, I'm just speaking now of cash in transit. Cash in transit. B has already paid, but maybe the year is just ending. Maybe it was paid one day before, so the year is just ending. So until the year ends, A has yet to receive anything. A hasn't received anything, right? So if A hasn't received anything, we presume that A has received it, even though it hasn't received. So A has to presume that it has debited cash, which we call cash in transit, right? Cash in what? In transit. And if it has received, we say that, oh, so A now doesn't have these trade receivables because it has received the cash. So some trade receivables have been extinguished. So I would have to credit trade what? Trade receivables this way. This way. So this is the entry that you would have to make, and after this, everything would be fine. The balance receivables on both sides would be the same. So I would like you to know that you would encounter something called goods in transit and cash in transit. And just to know is always goods in transit and cash in transit would cause trade receivables to exceed trade payable. Because, for example, here for goods, you have sold goods, you have recorded trade receivables, but this is yet to record, so trade payables are low. When you pay, the payer has already paid, it has reduced trade payables, but trade receivables are yet to be received. So in both cases, trade receivables would outweigh the trade payables. So this is all that I wanted to speak of here, and maybe just to make further points, I explained this already. So as for part two, this part of eliminating here and here, we'll see this in a deeper look when determining goodwill, right? So that's what I just wanted us to speak of.